Thanks, Max. And thanks to everybody for joining today. I think I know most folks in the room, but for those that don't know me, like Max said, my name's Conor McGuinness. I'm a partner with the fund out of Indianapolis. I hope nobody's sick of the word network yet, because I think we're going to say it another 30 times. But Max obviously introduced the concept because it's core to what we do every day. I'll share in a bit more about some specific outcomes that network enables us to really help create. But first, wanted to share how we meet these startups to begin with. There's a unique dynamic in our industry. On the one hand, funds are competing against each other. On the other, we're also collaborating. That collaboration takes the form of sharing deal flow. We do it with other funds all the time, where we're kicking the tires on a potential investment. We're talking to fellow funds who have invested perhaps in that space, get their opinion, et cetera. But the key is to make sure when you're hearing about other deals from other funds, you're seeing their top deals, right? You're not just seeing their leftovers. So the obvious question is, why would your premier Silicon Valley funds share their best deals with a Midwest manager, a smaller fund? And the answer is clear, because those funds have lived it. They've witnessed what we've done. And that is, we'll bring the first $1 million of revenue to the seed stage startups that we back. We've done it for Parkade. You'll hear from Evan in a bit about that. We've done it, just like Ryan Joyce said, in the case of Genlogs. We've done it with ParSpec, Workstream, and others. This is why top funds like Founders Fund, Peter Thiel's fund, or David Sachs's Craft Ventures continue to collaborate with Heartland Ventures. They see the value of the network. They see the value that that revenue brings. So in turn, it leads to us seeing the best deals, which you need to see to be a top performing fund. Like the portcos up here. In fact, 22 out of the 23 active portfolio companies we have been sourced through this channel. By that, I mean through the relationships with premier Silicon Valley funds. Deal flow is every venture fund's currency. But because of our network, Heartland's deal flow stacks up against the best. You can even say the funds that collaborate with us on deal flow are richly rewarded. As an example, to date, in just Fund 2, through the network, we've generated $66 million in pipeline revenue for our portfolio companies. This is, of course, a great thing, right? It's obvious. But one reason I'm stressing it here is these startups, they trade on multiples of revenue. The revenue we've created has so far led to the increases in value you're seeing up on the screen. You heard about Firmus, and yes, I'll share more in a little bit, but Anaya, it's doubled. Genlogs, doubled. Parkade, close to 7x. ParSpec, close to 9x. Much of this enterprise value growth stems from, again, the value the network creates. By the way, I mentioned earlier that we sourced 22 out of 23 of our portfolio companies through that Silicon Valley channel. But I left out what the exception was. You saw the story on Genlogs. That was the exception. Ryan Joyce, at the time we met him, again, the founder of that firm, was not actually interested in an investor. We wanted in, though. We liked Ryan, we liked what he was building, and we wanted a piece of the deal. So we quickly got to work and started to make intros throughout the network. You saw Jacob Scherb, a good friend at Indianapolis-based 3PL Fitzmark. But outside of Fitzmark, there were folks like C.H. Robinson, DHL, TQL. One of those even resulted in a 7-figure contract for Ryan. And at that point, Ryan, who, like I said, was previously not interested in an investor, thought that through and said, well, maybe I do now. Ultimately, we were able to get into the deal. And make no mistake, we own that company, part of the company, the fastest growing freight tech company in the country, because of our network.